Okay, so I'm going to start recording here. Welcome, guys. We are covering chapter 11 today. I think after this chapter, we've got 2 more chapters to cover in this book. So we're going to be talking about responsibility accounting. So we're the individuals that actually have the ability to take responsibility for the work, which generally is without top management getting involved. So decentralization, what does that mean? Well, it's often easy for top management to try to make all the rules, and yet they don't really have the wherewithal or the responsibility behind the processes, the procedures. And so by decentralizing it within organizations, the middle managers more often get to help input in decision making. So lower level decisions by those in middle management usually provide better results because they really know what's going on. And these managers, they call them lower level managers. Sometimes you call them middle managers, but they also get to be a part of the decision making, which hence is the responsibility accounting. The top management can put their efforts on just strategy, overall big picture, where the managers that are really doing the work can use their input and help out the customers ultimately. Everybody's happy when we try to decentralize all this decision making, because the ones that really are the ones doing the work should be able to make those choices. So those are the benefits. What are some negatives associated with this? Well, it's true. Managers that are really focused on their specific department don't always see the big picture. And oftentimes there might not be coordination among the various departments. And this is so true about objectivity. It's when that's all you know, it's difficult to be objective regarding other items in the entity because they just are unaware of it. So the focus here, though, is on those individuals who are in the day-to-day activities of a particular project or job should be able to be the ones that help become a part of making those decisions. Managers in responsibility accounting are the ones that are held up to the items, but only those items they're responsible for, the ones that they can somewhat control. A responsibility center is what we're going to use for any part of an organization whose manager has control over and is accountable for certain costs, profits, or investments. So in responsibility accounting, we're going to have cost centers. These cost centers are going to be controlling costs, not necessarily controlling the revenues. But the profit centers are those departments where the manager has control over costs and revenues. They, of course, don't have control over investment funds, but they have control over costs and revenues. Then, because we're breaking it down, the segment manager, a little wider, has control over costs and revenues and investments in the operating assets. So we've got the cost centers, we've got the profit centers, and then we've got the investment centers in the bigger scheme. So what we're going to start with is how we go about computing return on investment. Now, some of this might seem a little familiar in your financial accounting class when we dealt with all the ratios, but we're taking a look again at this in managerial accounting. So we're going to learn how to compute return on investment and show how when we change one account, be it sales or expenses or assets, how it ultimately affects our return on investment. So here's the formula. Net operating income divided by average operating assets. So income before interest and taxes is what we're going to use for our net operating income. The average operating assets, we're only going to take the cash, the receivables, inventory, property, plant, and equipment, and productive assets in this equation. Most companies use the net book value of the depreciable assets to calculate average operating assets. So meaning what's sitting on the books. Okay, we're not taking necessarily market values here. We're taking what we purchased it for minus any depreciation that has occurred in these assets. So in this return on investment, we're going to also pay attention to what we call the margin ratio, the turnover. So we can take return on investment by looking at net operating income and divide it by average operating assets. Another way to do it is to take our margin times our turnover. So you see basically the common item in the numerator and denominator here is sales. You see that? So our return on investment is also margin times turnover. Will get us the same results. Okay. So here's an example of a way we can increase our return on investments. So Regal Company reports net operating income, 30,000, average operating assets, 200,000, sales, 500,000, and operating expenses, 470,000. What would be the return on investment? Wouldn't it basically be the net operating income divided by the average operating assets, 30 divided by 200? You see this, the margin times the turnover, those just wash each other out there. Make sense? So if we look at our margin to be 6% and we look at our turnover to be 2.5%, if we multiply those, we're sitting at 15% return on investment. Assume that Regal's manager invests in a $30,000 piece of equipment that increases sales by 35,000, but it also increases operating expenses by 15,000. So a net of basically 15, right? So here in this scenario, our operating income is at 50. Our average operating assets now are at 230. We've got our sales of 535 and our operating expenses of 485. What will be our new return on investment? Again, our operating income divided by our average operating assets gives us 21.8%. Did it increase? Yes. It went from 15 up to 21.8%. So the negatives associated with return on investment. In the absence of having what is called a balanced scorecard, they might not know how to increase it. many things are inherited before they even get the job that they're stuck with. And managers evaluated on return on investment could possibly reject things that could be profitable opportunities. Again, not one area in itself is a great way to evaluate anybody. So the second piece here is now we're going to look at what's called residual income and understand its strengths and its weaknesses. So what this is income above some minimum return on operating assets. So in this, we're going to take the net operating income minus the average operating assets times the minimum required rate of return. It's different from return on investment because ROI measures net operating income earned relative to the investment in average operating assets, which we know of. But this measures net operating income earned minus the minimum required return on average operating assets. Okay. So the retail division of Zephyr has average operating assets of 100,000 and is required to earn a return of 20% on these assets. Currently, the division earns $30,000. So to calculate residual income, we take the operating assets times 20%. So they're required to earn 20,000. Okay. The residual income would be anything above that requirement. So if in fact they earn 30, the residual income is 20,000, the excess of the minimum requirement of income on the assets. Make sense? Residual income encourages managers to make profitable investments that could be rejected by managers just using ROI. So guys, let's look at this one. Redmond Awnings, a division of Wrap Up Corp, has a net operating income of 60,000 and average operating assets of 300,000. The required rate of return for the company is 15%. What's the division's ROI? What do you guys think? If they made 60, operating assets are 30 times 15, wouldn't the minimum income need to be 45? So 60,000 divided by 30, 300,000. Okay, 60,000 divided by the operating assets. Oh, they're asking ROI, not residual. So the ROI is going to be 20%. Okay, which would have been the 45,000, right? ROI 20%. Redmond, a division of the Wrap Up, has net operating 60, operating assets of 30. If the manager of the division is evaluated based on ROI, will she want to make an investment of 100,000 that would generate additional net operating income of 18,000 a year? No, because isn't that under the return of 20%? You see, if an investment of 100,000, she needs to have a minimum of 20% return, which would have been 20,000, to just make it even. This will only hurt her return on investment. Got it? The company's required rate of return now is 15%. Would the company want the manager of the Redmond Awnings division to make an investment of 100,000 that would generate additional operating income of 18,000 a year? Yeah, because that, the minimum is only 15,000. That would create 18%. Okay, make sense? Redmond Awnings, a division of Wrap Up Corp, has a net operating income of 60,000 and an average operating assets of 300. The required rate of return for the company is 15%. What is the division's residual income? C, exactly. The 15,000. Anything above and beyond the 45,000 would be the residual income, wouldn't it? If the manager of the Redmond Awnings division is evaluated based on residual income, will she want to make an investment of 10,000 that would generate additional net operating income of 15,000? Yeah, if the required return is only 15, that's going to exceed that. That would give her some residual income. Now, transfer prices. Objective 3 here. Determine the range within which a negotiated transfer price could fall. So what's a transfer price? The price that's charged when one department of a company provides goods and services to another department of a company. The objective in setting transfer prices is to encourage managers to act in the best interest of the overall company. Okay. 3 approaches to creating transfer prices. Negotiate them, set transfer prices at cost using either variable or full absorption costing, or look at the market prices. A negotiated transfer price results from discussions between both divisions. Advantages of doing this: each department can remain independent. The managers negotiating the transfer prices are likely to have better information about the cost and benefits. And when you're dealing with transfer prices, you're going to have an upper limit and a lower limit. Of course, the upper limit's determined by the person who's buying it. The lower limit's determined by the person who's selling it. So, West Coast Plantations and Grocery Mart are both owned by Grocery Storehouse. So West Coast Plantation has the oranges, and the Grocery Mart sells the oranges. Okay, so we have the capacity, the $10 per crate is the variable cost. We have our fixed cost, and they sell these navel oranges $25 per crate. Okay. The Grocery Mart, they are purchasing these navel oranges for $20 a crate. Okay. So they're selling 1,000 crates a month. They're purchasing from 20. But the plantation is selling them for more than what they're purchasing them for. The lowest acceptable transfer price is calculated by, if the transfer price is going to be greater or equal to the variable cost per unit plus the total contribution margin on the lost sales divided by the number of units transferred. So the buying division's Grocery Mart highest acceptable transfer price will be calculated by, the transfer price versus the cost of buying from an outside supplier. If an outside supplier doesn't happen, then the highest acceptable transfer price is going to be the profit to be earned per unit sold. Okay, so only if West Coast has some idle capacity, 3,000 crates, to satisfy Grocery Mart's demands of 1,000 crates without sacrificing sale to other customers, then the lowest and highest possible transfer prices are computed by, in the seller, it's got to be greater than 10 bucks plus whatever divided by 1,000 units to equal our 10 bucks here. So the cost of buying from an outside supplier is at 20. So in this case, for the grocery store house here, the transfer price would have to be between 10 and 20. However, there's no idle capacity. And in this case, you see here, the selling division's lowest possible transfer price, because there's no idle capacity, is going to be the 25 bucks, what they're able to sell it for. The buying division's highest possible transfer price is only 20. Guess what's going to happen? It's not going to be, right? If West Coast Plantations has some idle capacity and must sacrifice other customer orders to meet Grocery Mart's demands, then the lowest and the highest possible transfer prices are then computed by the person who's selling the $10 plus the 25 minus 10 times 500 crates, divide that by 1,000, or 1750. Again, for the buying it from the outside seller, they're able to get it for 20 anyway, right? So in this case, based on this scenario, the transfer price is going to fall in a range between 1750 to 20. If a transfer within a company would result in higher overall profits for the company, there's always a range of transfer prices within which both the selling and buying divisions would have higher profits if they agree to the transfer. But if the managers are against each other for whatever reason, with a non-cooperative or argumentative atmosphere, it's not going to happen. Given the disputes that often accompany the negotiation process, most companies rely on some type of other mean in order to set transfer prices. Okay, excuse me, guys, I'm just yawning. Transfer at the cost to the selling division. Many companies set transfer prices at either variable cost or full absorption cost incurred by the selling division. The negatives can be not as beneficial here. The selling division would never show a profit on any internal transfer, and they don't really incentivize controlling costs if this would be the case. You can transfer also at market price, a price charge for an item in the open market, which is usually the best way in which to handle this. A market price approach works best when the product or service is sold in its present form to outside customers and the selling division doesn't have idle capacity. It doesn't work well when the selling division does have idle capacity. Okay, let's look at a problem. Let's just stop now and take these 3 points and look at a problem here, okay? Okay. Let's look at this exercise 2 with residual income. We've got here Juniper Design of Manchester, England, provides design services to residential developers. Last year, the company had operating income of $600,000 on sales of $3 million. The company's average operating assets for the year were $2,800,000, and its minimum required rate of return was 18%. Compute the company's residual income for the year. Okay. Wouldn't we do excuse me, 2. We take the average operating assets, which they gave us, the net operating income, and if we know the minimum required rate of return is 18% on 2.8 million, that would be 504,000. So anything above 504,000 is going to be residual income. Make sense? Okay. Whoops. Next. Let's see. Oh, this is a big one. I don't want to overwhelm us. We'll just take pieces of it. Seiko Company's audio division produces a speaker that is used by manufacturers of various audio podcast products. Sales and cost data show our selling price per unit in the intermediate market, the variable cost, the fixed cost, and the capacity in units. Seiko Company has a hi-fi division that could use this speaker in one of its products. The hi-fi division will need 5,000 speakers per year. It has received a quote of $57 per speaker from another manufacturer. Seiko evaluates division managers on the basis of divisional profits. Assume the audio division sells only 20,000 speakers per year to outside customers. From the standpoint of the audio division, what is the lowest acceptable transfer price for speakers sold to the hi-fi division? Okay, so this one is just going to start with the transfer price is going to be greater than or equal to the variable cost per unit plus the total contribution margin on lost sales, divide that by the number of units transferred. Since there's enough idle capacity, they're only shipping out 20, they can make 25,000 to fill the entire order from the hi-fi division. No outside sales are lost. And because the variable cost per unit is 42, the lowest acceptable transfer price as far as the selling division is concerned would be $42 just to handle the variable cost. Okay. Next, from the standpoint of the hi-fi division, what is the highest acceptable transfer price for speakers acquired from the audio division? So they can buy an outside speaker for 57. They can get that anyway. That's the highest they're going to take, or they'll accept, correct? So the highs and lows here between the departments, there would be a low of 42 and a high of 57. Make sense? Next. From the standpoint of the entire company, do you think this transfer should take place Why or why not? The cost of the speakers transferred is only $42. And ultimately, the company says the $57 cost of the speakers purchased from the outside supplier. I mean, they're saving $15 by purchasing them within. If you look at the biggest picture, not the individual departments. Okay. Okay, we're gonna move on. Now, the next one is how we charge various operating departments within a company for services that get provided by the service department within a company. So operating departments are how the company functions. The service departments don't necessarily make the money, but they're necessary in order to have the company run efficiently. Service department costs are charged to operating departments for a variety of reasons. To encourage operating departments to wisely use service departments' resources instead of just, oh, I can do this again. I can, okay? To help measure the profitability of those operating departments. To provide operating departments with more complete cost data. And to create an incentive for even service departments to operate efficiently. How do we charge? Well, we're going to take both the variable and fixed costs that should be charged to the various operating departments. The variable service department costs should be charged to the departments according to whatever is driving the cost or incurs the cost. And they will take the fixed charges, the fixed service department costs to the departments in predetermined lump sum amounts that are based on the consuming department's peak and long run average servicing needs. So, should actual or budgeted costs be charged? Budgeted, variable, and fixed service department costs should be charged to these operating units. Here we've got SIPCO. SIPCO has a maintenance department and two operating departments, cutting and assembly. Variable manufacturing costs are budgeted at 60 cents per machine hour. Fixed maintenance costs are budgeted at $200,000 per year. Data related, we show our percent of peak period capacity for cutting is at 60%. For assembly is at 40%. Here's what the planned hours were, but here's what actually was used. So cutting went up, but assembly was down. So SIPCO, at the end of year one, here are the actual hours used. The cutting department is going to be charged $48,000 based on actual hours times the budgeted variable rate. And the assembly department is going to be based on actual hours times the budgeted rate. The fixed costs are based on that peak period capacity, which shows you the allocated costs, both variable and fixed. Let's look at this. Foster City's got an ambulance service that's used by two public hospitals. Variable ambulance costs are budgeted at $420 per mile. Fixed ambulance costs are budgeted at $120,000 per year. Data relating to the current year, we see the peak capacity, the miles planned, but then the ones that actually were used. Okay, so how much ambulance service costs will be allocated to Mercy Hospital at the end of the year. We've got the 120 and the variable ambulance budgeted at 420 per mile. There's 33,000 miles. Wouldn't it be variable cost allocation? Excuse me, let me look at this. The true miles used here are 16,000 and 17,500 at our budgeted cost. And then the 120,000, we allocate it based on the heavy peak use. So Mercy is going to be at 121.2. Does that make sense how we figured that, guys? Pitfalls in allocating fixed costs. Fixed costs allocated to one department are heavily influenced by what happens in other departments. Using sales dollars as an allocation base might not necessarily be fair. Sales of one department influence the service department costs allocated to other departments. So let's look at this one. Autos or Us has one service department and 3 sales departments: new cars, used cars, and car parts. The service department costs total 80,000 for both years in the example. Contrary to good practice, Autos or Us allocates the service department costs based on sales. So in the new versus used versus parts, we've got a total sales of 300,000. Since the new sales are 1.5 or 50% of the total, they get allocated 50% of the cost. Used gets allocated 30 and parts are 20. So do you see how they're allocating them based on sales? So here we've got the allocations. The second year allocation, again, based on sales. So in this example, since the new sales were 57% of the total, the allocation of the service department increases just because the sales were a greater percent of the total. If you were the manager of the new cars department, wouldn't you complain about the increased service department costs that get allocated to your department? Sure doesn't seem fair because you're working harder. You're getting caught, put more expenses on. So the allocation might be off, the way in which they're computing it. Let's go back and look here. Let's look at exercise 11.4. Okay. Hannibal Street Company has a transport services department that provides trucks to haul ore from the company's mine to its 2 steel mills, the northern plant and the southern plant. Budgeted costs for the transport service department total $350,000 per year, consisting of 25 cents per ton variable cost and 300,000 in fixed costs. The level of fixed cost is determined by peak period requirements. During the peak period, the northern plant requires 70% of the transport services department capacity, and the southern plant requires 30%. During the year, the transport services department actually hauled 130,000 tons to ore to the northern plant and 50,000 tons to the southern plant. The transport services department incurred 364,000 in costs during the year, of which 54 were variable and 310 were fixed. How much of the transport services department's variable cost should be charged to each plant? How much of the transport services department fixed costs should be charged? And should any of the transport services department's actual cost of 364 be treated as a spending variance and not charged to the plants? Okay. Okay, so how much of the variable costs are going to get charged to each plant? Well, if we are doing 25 cents per ton, the northern plant had 130,000 actual tons. The southern plant had 50,000. You see how that's getting charged. The fixed costs were based on peak time, right? With northern being 70%, southern being 30%. You see how we're allocating those costs? So we're allocating $345,000. Part of the $364,000 in total costs will not be charged to the plants. Here, total fixed costs incurred, the variable cost were $54,000, but we charged to the plants 45. So there's a spending variance of 9 here. And then there's a spending variance of fixed costs of 10. The spending variances represents cost incurred in excess of the budgeted 25 cents per ton. Is that the different northern plant and southern plant's fault? They overspent? No. If in fact the budgeted costs are reasonable, but you got to go on what they budget. So they shouldn't be charged something that's above and beyond what they budgeted for. Okay, that makes sense, right? Yes? Okay, now let's look at return on investment, transfer pricing. Let's look at another transfer pricing. To me, that can be the most confusing. Transfer pricing. Oops. Okay. Division A manufactures electronic circuit boards. The boards can be sold either to Division B of the same company or to outside customers. Last year, the following activity occurred in Division A. So the selling price per circuit board, 125, the variable cost, 90. The number of circuit boards produced, 20,000, sold to outside customers, 16, and sold to Division B are 4. Sales to Division B were at the same price as sales to outside customers. The circuit boards purchased by Division B were used in an electronic instrument manufactured by that division, 1 board per instrument. Division B incurred $100 in additional variable cost per instrument and then sold to the instruments for $300 each. I got to read that one again, sorry. Sales to Division B were at the same price as sales to outside customers. The circuit boards purchased by Division B were used in an electronic instrument manufactured by the division. Division B incurred $100 in additional variable cost per instrument. Okay, got it. And then they sold the instruments for $300 each. So we are going to first calculate the net operating incomes earned by Division A and B and the company as a whole. Okay. So sales, Division A is the 20,000 units at 125 a unit. Division B is the 4,000 units at $300 a unit in the total. The expenses added by the division, 1,800,000 here, Division B, 400,000 for a total of 2,200,000. And the transfer price paid 500,000 here. So we've got our total expenses, and here's our net operating income. Okay. Now, in this case, we're taking this 500,000 here. This 300,000 shows the operating income in this particular division. Note that the 500,000 in intra-company sales have been eliminated in terms of the overall picture. So these here show you part one. Part two says, assume Division A's manufacturing capacity is 20,000 circuit boards. Next year, Division B wants to purchase 5,000 circuit boards from Division A rather than just 4,000. Circuit boards of this type are not available from outside sources. From the standpoint of the company as a whole, should Division A sell the $1,000 additional circuit boards to Division B or continue to sell them to outside customers? So if we look here, they're saying it should get transferred. Division B's processing adds $175 to each unit selling price, but it adds only $100 in costs. Therefore, each board transferred to Division B yields $75 more in a contribution margin to the company than is obtained when Division A sells to outside customers. The company as a whole will be better off if Division A transfers the 1,000 additional boards to B. Okay. Do y'all want to do any more? The return on investment, in my opinion, is kind of straightforward. It's the transfer prices that make it a little more confusing. Well, let's look at the homework. Okay.